Hello and welcome, everybody. I'm Vern Cushenberry, Chief Investment Officer, and I'm back with another market overview for the fourth quarter of 2022. And I want to give you the bottom line up front. As always, the markets are still normalizing. We talked about that a little bit last quarter. We basically shut the entire economy down for COVID and then resuscitated the economy with historic stimulus measures, and those started to cause a little bit of inflation, and the Federal Reserve started to raise interest rates in response to that. And all of those measures have secondary effects. And those secondary effects are trickling through the economy. But we've seen this before. I want to share with you some data today that shows economic and market indicators are within a normal range. So what does that mean for your portfolios? Well, it means that we've stress tested your financial plans, and most of the conversations that we're having today put clients in a position where they're still on track to meet their goals. But as always, I will end this little video with a suggestion that you reach out to your advisor and schedule an appointment to confirm those goals and that you are on track. So with that, let me jump right into it. Here's the data from the fourth quarter. You can see here that international stocks led the way, up 16% in the fourth quarter. Last quarter, maybe the quarter before, I touched on international stocks lagging domestic stocks. They had gotten relatively cheap. So that partially corrected in the fourth quarter, but still on the cheap side. You can see on this next slide that we were down on the year. And what I want to touch on a little bit today are the primary drivers of that. And one of the standouts from an economic indicator perspective was the 10-year Treasury yield. As those inflation numbers started to creep up and as inflation started to creep into the economy, the Fed employed countermeasures, primary of which is increasing interest rates. And it's important that we understand how rising interest rates affects the economy and our portfolios. So let me jump to the next slide here. Okay, this slide shows interest rates. I want to spend a little bit of time on it to make sure that everybody has a good understanding of what this slide indicates, because this video goes out to a lot of investors who are knowledgeable about the markets, but I never want to take that for granted. So this is a chart that shows the yield curve. And if you look down at the vertical axis, you see fixed income investments. So these are bonds. We're talking about bonds here that mature anywhere from 3 months out to 10 years out to 20 years out to 30 years out. And generally speaking, the longer the maturity, meaning the longer amount of time that you're going to borrow money for, the more expensive that is, the higher the yield that a borrower is going to have to pay. And that's exactly what we observed a year ago. This is called the yield curve. Longer maturities had a higher yield, generally speaking, and that's a normal yield curve. What we've experienced in the last 12 months is the Federal Reserve, which has direct control over the interest rates that short-term borrowers pay. They've significantly increased that interest rate. Now you can see that the interest rate on short-term borrowings for banks is, it's up around that 10-year range, as indicated in the gray swath here. Everything in gray is the 10-year range. So on the short end of the yield curve is towards the top of that range, and you can see that borrowers inside of a 10-year, 20-year, 30-year time span, they're paying a little bit less than that. Now, why is that? That's not normal. Well, the reason for that is lenders that are loaning to borrowers for periods of 10, 20 years, they are not currently making the assumption that this inflationary environment is going to last. So if to the extent that this yield curve is representative of Wall Street's best thinking, which oftentimes it absolutely is, the assumption is that these interest rates are not going to last beyond, say, 2023, or these interest rates would be higher. So maybe that's the case. There's a lot of pundits arguing that right now. But what we can look at is this next chart that shows fixed income valuations. So on this chart, we're looking at yields. So this is a chart that shows yields, and yields are on the vertical axis over here. And then across the horizontal axis, you can see all different segments of the fixed income market. So let's focus on US Treasuries for a moment. The gray bar here shows how yields have fluctuated in the last 10 years. So for US Treasuries, we can see that the last 10 years, those yields have traded between, just call it 0.5% on the low end and 4.5% on the high end. The purple bar represents the 10-year average. So the average of the last 10 years, we've seen US Treasuries yield about 1.5%. Here's where we are today, 4.2%. So the yield is significantly above its 10-year average. That's a great thing for fixed income investors. Look at municipals. The yield is significantly above its 10-year average. And if you pan across each segment of the fixed income universe, you can see that yields across the board are higher than they've been on average in the last 10 years. That represents opportunity. So that opportunity comes at a cost, you might say. As yields rise, prices fall. Or to say it differently, as we've experienced price declines this year in typical fixed income portfolios, our yields have risen. So over the life of those fixed income investments, we can expect to generate the same return that we were expecting 12 months ago. But we balance the higher yield against the price volatility, and I want to give you some detail on how that affected a balanced portfolio this year. So in this slide, we're looking at the annual returns to a 60-40 portfolio. So this is a balanced portfolio, a mix of debt and equities. And you can see that there was no place to hide last year. Both fixed income investments and equity investments fell on the year. The balanced portfolio was down 16%. And if you look back across the last 70 years, this chart shows that was the third worst year for a balanced portfolio on record. Then, but we've seen this before, and I've shared this chart. And this is, in my estimation, one of the most profound, one of the most helpful, one of the charts I try to get in front of our investors at least twice a year, if not more, because it's important that we keep our eye on the ball, so to speak. And we do that by recognizing the value of patience. So bear with me if you've seen this before, but it looks at the returns to stocks, bonds, and the gray is the balanced portfolio over 1 to 20 year periods. So we looked back at the last 70 years and we analyzed every single year in that 70-year time frame. And what we observed was that stocks are volatile. They fluctuated between down 39% on the low end and up 47% on the high end. Bonds were a little less so, down 13% on the low end and up 43% on the high end. And then a balanced portfolio typically allowed us to mitigate some of that volatility. You can see any single year time frame was down 15% to up 32%. Now, over a 5-year period, watch those returns come in and compress. Stocks, bonds, balanced portfolios. You can see here, if we go back 70 years, the balanced portfolio has never had a negative return over any 5-year period. So like I say, we have been here before. We've observed this before. We know what recessions feels like. We know what rising interest rate environments feel like. We have a good idea of what we can expect in the future. One of the things we can expect in the future is rising yields. Those rising yields will allow us to generate higher returns on our portfolio in the future. So much so that as we pan out to 5-year, 10-year, 20-year time periods, investors can take a deep breath, focus on the data that has always allowed returns in the markets, and hopefully sleep a little easier at night. Now, I want to revisit a concept that is challenging for investors because it highlights just how important that measure of patience is. Remember, I said these returns are available to patient investors. But one of the challenges in living out that patience is when markets are volatile, we fight that reaction, that urge to want to sidestep some of that volatility and move to cash. Well, when we do that, we put our portfolios, for one, in danger of missing the upside rallies. And we saw that on November 10th when CPI was reported, and the numbers were better than most of Wall Street thought they were going to be. And as the markets can be, they were very reflexive to the upside. On November 10th, the S&P 500 was up 5.5% on the day. That's a huge upside move. Had you been in cash, you missed that whole move. And the likelihood of making that up, as we've observed through careful study of investors over time, is very, very low. So at the end of your investing career, if you have a portfolio of $1 million and you just missed a 5% day, a 5% single day, well, you cost yourself $50,000. And that's very, very challenging to make up, which is illustrated in this next chart here. And I just wanted to revisit this concept because I've looked at this chart hundreds of times, and it's not intuitive because it shows the magnitude of missing out on the best 10 days in the market. And because it's not intuitive, it's worth spending a little bit of time on. So the chart's entitled Impact of Being Out of the Market and looks at the returns to the S&P 500. This is a $10,000 portfolio. The date range is between January 1, 2002 and December 31st, 2021. So call it a 20-year period there. But I've seen similar data covering 50, 70, 100-year periods. If we look at a portfolio that was fully invested throughout that time, so an investor here adhering to the virtue of patience, they captured a 9.52% annualized return. Now look at what happens if that investor misses just the best 10 days in the market. Their portfolio drops from $61,000 at the end of that 20 years to $28,000. You've cut the value of that portfolio in half, more than half, just by missing 10 days in the market. That's how reflexive the market can be. That's how reactive the market can be to upside news. So if you think you're going to move to cash and get back in before the market has an opportunity to price in good news, maybe. I've seen investors do it. I generally attribute it more to being lucky than good, because when you analyze the investing public at large, the vast majority fail to do that. And when you fail, you can quickly erode 20 years worth of buy and hold returns. So I always try to end these little talks with a revisit to some timeless investing wisdom, and patience is a piece of timeless investing wisdom. Work with your advisor to make sure that that virtue, that wisdom is getting applied to your portfolio in a manner that helps you achieve your goals. And again, I invite you to reach out to your advisor, sit down, make sure you're doing that a couple of times a year, if not more, when the markets are volatile, if for no other reason, just to make sure you have peace of mind. And I will be back in another quarter with another market update. Thank you for your time.